Hello everyone, welcome back to the next lecture on our blockchains course. We had a couple of lectures talking about use cases in financial services. So this will be the third one in that series, talking again about use cases in financial services. Now we're going to go a little bit into the commercial side of financial services, specifically about financing trade. So this is an area that my colleagues and I have been working on ourselves for the last couple of years. This one and more on trade and supply chain. So that'll be the topic of the next few lectures. That's actually very close to my heart and something that I've been directly working on for the next couple of for the last couple of years. How does the trade world work today? So the international trade, is probably the backbone of world economy today. So most of the things you have in your home have probably been transported on a ship at some point or the other, right? So all the way from the regular even food articles, some of them you get imported fruits and so on. It could be electronics; those are imported, exported, and there's a lot of the regular day-to-day activities, regular day-to-day items that are actually shipped over sea. We don't really realize that because we don't see the back-end supply chain of all of these things. Today's world, this whole process is extremely complicated. Let's say there's a small exporter who's exporting, let's say, mangoes from India to, let's say, France, right? Today, that farmer or a small enterprise has to be working with several participants today. So there may be an exporter in India, so they have to work with a logistics provider, maybe a trucking company, to transport their mangoes to a warehouse or to the port, and then they have to work with a shipping line or a carrier to transport over a ship, and then they also have to be working with customs in India, also customs in France. They have to be working with ports along the way. So there's and also freight forwarders, customs brokers, and various other entities who are going to be handling the shipment all through the life cycle. And it's not just the people who are handling the container of the shipment itself. There's also a huge range of documents that they need to prepare to adhere to export regulations and import regulations. So the Indian Customs Authority will say, okay, if you're shipping mangoes, then these are the set of documents that need to be prepared. Likewise, the French customs might say, okay, these are the documents we require for you to import mangoes into France. And the kind of documents that are needed are, let's say, it could just be about your packing list or your invoice that says what really you're shipping. Or it could also be, let's say, you might have to go to a phytosanitary, you might have to get a phytosanitary certificate to certify that these mangoes are not infected, or they are of good quality, they're of export quality, and they're okay to be exported out of India. So there are many such regulations for which they have to prepare documents, and they also have to maybe pay export duty. So they have to have a separate document and a seal from an authority saying they've paid the duty. So there's a lot of these documents that need to be prepared. This picture basically shows some of that complexity. So it shows how the container itself moves from one port to another port, or one yard to another yard. And there are a lot of inefficiencies, right? So typically, on an average, it's estimated that about 12 parties are involved in a single shipment. And there's on an average 27 documents. So in my own experience, there are certain goods for which you need even up to like maybe close to 100 documents, because they may be dangerous goods, or they may be restricted goods. So there's a lot of documentation that's required, and that's very cumbersome. And there's very little automation. So it's all manual processes, paper-based documents that are in place today. And all this adds to the risks, right? So because of the fact that this is international trade, you're also dealing with multiple currencies. So you're subject to currency fluctuation issues. And there's also issues with what if the shipment doesn't reach the other end? So there's a non-completion issue itself, and on both sides. So exporter has to ship the goods to the importer. Importer needs to pay the money to the exporter. So there's both ways exchange that's happening. And the end result of this is that financing becomes very expensive. And in a country like India, that's a very severe limitation, because we have a large number of small and medium enterprises, and they are very much dependent on financing for their capital inflows, outflows. So if the financing is going to be very expensive, then just exporting becomes a impossible task for them. So they are restricted to the markets only in India, and they can't leverage some of the demand that's there outside India. So that's the SME lockout that is mentioned here. So what can we do to alleviate this situation? So what if we can get some of these participants, maybe even all of these participants, onto a blockchain platform where they all securely share information? So what we can achieve is end-to-end real-time visibility into exactly where your containers are, what documents have been prepared already, what documents are still pending, what approvals need to be obtained from various authorities. So all that, everyone can get real-time visibility into exactly what is going on. And along with that, we can automate some of these business processes that are transcending organizational boundaries. So I talked about how many documents have to be prepared by different participants. This is actually a sequential process that people have to follow. So you need a set of documents. Once they are prepared, you may need a couple of other documents that are dependent on the first documents and so on. So that entire process can be captured in an automated fashion as smart contracts on blockchain. And these smart contracts can have additional intelligence. So they can actually eliminate some of the manual verification and the validation of the data elements in these documents. So people actually manually look through these documents and see whether they are okay. Now you can automate some of those aspects as well. So making sure all the documents are matching, the information is all correct. So all that validation can also be automated. And you can, of course, have restricted access. So certain documents you can only allow certain participants to view based on their authorization. So what are they allowed to see? You can only show those things to them. So that's part of the access control that we've looked at. And at the end of the day, if there are regulators in the picture, they are part of the blockchain as well, then they can also get a real-time view into this, and it can really help them address fraud. Today, trade fraud is a huge issue. It's in the trillions of dollars worldwide today. And even if we can address a fraction of that through technology, I think it can make a really big impact. So today, overall, over $14 trillion of trade is being financed. This is just the trade that's being financed. It's not the overall amount of trade. And it takes up to 3 weeks for just the documents to be verified. The actual shipment itself from India to France can go faster over ship. It probably takes maybe less than 10 days to go over ship. And by just eliminating some of this paper, it's estimated that we can save about $27 billion. It's a huge amount of money. So what does trade look like? Trade finance look like? And let's see how we can impact this. There are various forms of trade finance, as you might imagine. So in this picture, it shows some of the least secure modes of trade finance today to the most secure ones. So for instance, if you take one example where cash is paid in advance. So the importer is going to pay the exporter in advance, and then only then will the exporter ship the goods the other way around. So now if you think about it, the importer has paid the money in advance. What if the exporter doesn't ship the goods? So the risk of non-completion is fully borne by the importer here. So it's it's not secure for the importer, but it's secure for the exporter because they have the money, they've got the money, and only then they are obliged to send the goods. So that's cash in advance. The other extreme is what is called an open account, where exporter is going to bear all the risk. So they are expected to send the goods in advance, and only after the goods have reached the destination and have been verified there, will the importer then pay back. So there, in this case, the exporter is going to bear all the risk, and it's least secure for them, whereas the open account is most secure for the importer. There are other forms of financing in between. So these two actually may not even involve a bank. The cash in advance and the open account may not even involve a bank or a financial institution. It might just be an agreement between the importer and the exporter. One party, for whatever reason, agrees to absorb the risk, and they send the money across. And of course, there are problems that happen along the way, right? And relationships and there may be lawsuits and so on, right? But when financing comes in, there are multiple modes. Again, I'm going to talk about just two of them. One of them is called letter of credit. It's actually a fairly popular way of financing today, where a bank comes in the picture. Let's take for example, it's the importer's bank. So the importer's bank will say, exporter, hey exporter, you may not trust the importer, but I will guarantee that if you send the goods across, I will verify, the bank will verify, and will make sure that you get the payment. So the bank now assumes the risk of payment of non-completion. The importer maybe pays a fee to the bank to assume that risk, and exporter that thereby is now has probably a more reliable entity, maybe a large bank that they can trust and send the goods across. So the way the letter of credit works, we'll talk about it in the next slide. But the other version of it is documents collection, where the bank is in the picture, but bank may not assume the risk of non-completion. So if the money doesn't get paid, the bank is not liable. So bank is not going to pay the exporter. But the bank will assume the responsibility of just collecting the documents that are required, so that the importer or somebody else can verify those documents. So there are many forms. What I wanted to impress on this slide is there's a huge range of these financial instruments today, all the way from being very less secure for one of the parties to being fairly secure and trusted and executed by 2 or more banks in this ecosystem. And in some cases, when the letter of credit is involved, then maybe even 5 or 6 banks that are involved. There could be a guaranteeing bank, there can be correspondent banks because there's a currency exchange, there could be negotiating banks that help negotiate terms of the agreement. So there are many banks that are involved in even a single financing situation for a single shipment. What are some of the advantages if you can bring in blockchain? Right, so as I mentioned, who are the parties first? Right, so of course the exporter, importer have to be involved. So they are the 2 parties who are fundamental to the trade, and they have this fundamental discord. Right, importer is worried that the exporter will not ship the goods. Exporter is worried that the importer will not pay. So they are both reluctant to be the first to show their end of the deal. Right, so both of them employ banks, and hopefully these banks are trusted. So that's how the world works today. And it may not be just the importer's bank and the exporter's bank. There may be other banks involved. There could be a regulator involved. There's other investors who might be involved. So this is actually a fairly complex ecosystem. And this is this whole process that is out there. I'm going to let you see it at leisure. But I want to impress upon the fact that there's a fairly complex interaction that's happening even between these 4 parties. There are actually more parties that are not shown in this figure. So what blockchain brings in, if you can bring these parties onto a blockchain platform, is that it can give you an unambiguous shared view of exactly what has happened so far, what needs to happen in the future. It's a common store for all documents. So whether there are multiple kinds of documents here. And as I mentioned, it can automate business processes on the blockchain. So you can have smart contracts that are executing these business processes, and they can automatically validate whether a particular step has happened correctly, whether the document is valid, and so on. And of course, as I mentioned, there are many different instruments, trade financing instruments with different levels of security and different risk assumed by different players. And of course, you can encode them as different kinds of smart contracts. So Vitatrade is actually an existing consortium of banks who are running a blockchain network for their trade finance purposes. So they are running this in partnership with IBM. So there are actually 9 banks who are involved in this consortium today, and maybe potentially other banks could join them in the future. This is all banks in Europe. Some of them have a global footprint, like HSBC or even Deutsche Bank is there in multiple geographies. And they are using blockchain today to extract some of these benefits, to have this real-time visibility into the information that is being exchanged for a trade finance use case. And they are looking at ensuring that they have continuous business automation and also compliance. Right? So blockchain can give you an auditable log of everything that has happened, and banks can use that to show regulators that they are complying with trade practices. So every country has regulations on what can and cannot be done, and banks are expected to show proof for basically to an auditor that they have been complying to regulations. So that is one real-world production application of blockchain that's running today. So let's move on. So a related topic to trade finance is actually supply chain finance. So there's a little bit of distinction into how or what the use case itself is. So let me just describe the use case first. So I'm going to take this picture as an example. So let's say there is a large manufacturer, right? They are the buyer, So let's say this is Tata Motors, right? Tata Motors probably works with hundreds of suppliers. Each supplier may be supplying, let's say, a small automobile part, maybe let's say nuts and bolts. So the supplier who's a small scale enterprise who is just manufacturing nuts and bolts, and they are selling these to Tata Motors. And there is a financier in the picture. So Tata Motors is a big company. The supplier is probably a small entity here, and L here is the logistics provider. So there is a logistics provider. So let's see how this process itself works today. Just one example of supply chain finance. There are other flavors as well, but let's just take this example. So the supplier now creates a purchase order. Sorry, the Tata Motors creates a purchase order saying, I want to buy. Let's just for example, I want to buy 1,000 nuts and bolts from you. So they create a purchase order, send it to the supplier. The supplier then would package those nuts and bolts, and they would send it through a truck through a logistics provider, and this will get delivered at a Tata Motors warehouse, for instance. They parallelly also send an invoice to Tata Motors saying, hey, I've shipped these goods across, they'll reach you tomorrow. But this is the invoice for this shipment, and you need to pay me whatever 10,000 rupees for this shipment. Now Tata Motors, what Tata Motors typically does is it probably needs it has its own supply chain, it has its own orchestration, so it probably will take a few days to even verify that the shipment has come in, look at the quality, assess the quality of those nuts and bolts, say they're okay. So there's multiple steps that Tata Motors would internally do, and it typically takes time. And the arrangement is usually that Tata Motors would pay the supplier after maybe 30, 60 or 90 days, depending on the agreement, back to the supplier. So they will pay the money only later. Now, there are oftentimes the supplier is a very small company, right? Unless they get paid for the ones that they've already produced and sold, they can't produce the next batch of goods, right? Next batch of nuts and bolts. So they need money to produce the next batch. So what they do is they go to a financier. So now if the small company goes to a financier, then this bank is probably not going to give them a very good interest rate because they don't have a very big credit history and they may not be a big company, right? So their loan rate might be fairly high. But if the supplier can show that, hey, I've actually sold goods to Tata Motors, this big company, then what the financier would do is, oh, I do trust Tata Motors more, right? They're not going to run away anytime soon. I will give you the money now, right away. When you show that you've sent goods to Tata Motors, the financier will pay the supplier immediately, right? And after the 30, 60, 90 days, whatever is the agreement between the supplier and the purchaser, or between Tata Motors and the small company, they will collect that money from Tata Motors. Now, the advantage for the supplier is, one, they got the money early. They didn't have to wait until Tata Motors does all its processing and pays it after 30, 60 or 90 days. And the second thing is they got a lower interest rate. So they basically got a loan of some sort at a lower interest rate. If they went for a loan with a bank directly, they would not get that interest rate. They got an interest rate at the rate maybe Tata Motors would get a loan, right? So that's the advantage for the supplier. Now, advantage for Tata Motors is that they get their 30, 60, 90 days to process this shipment, and then they can take that time to make the payment. And if some things are not good, they can raise a discrepancy. They can raise an issue. And of course, financier out of this, when they are getting the money, when they are giving the supplier, they might give 100. When they're getting from Tata Motors, they'll get 105. So they get the cut. Or it might be the other way around. They probably give the supplier 95 and get 100 that the supplier was owed from Tata Motors. So they get the interest rate cut from this transaction. So in this ecosystem, almost everyone benefits, right? But there are, of course, challenges. The challenges is that it's now this process itself. I just showed one shipment, right? This might be like a periodic shipment. The supplier sending goods to Tata Motors. So it's difficult to get a consistent view of the status across all the shipments, across all the entities in this ecosystem. There's also the issue of what if the supplier sells this or shows this invoice to two financiers. Now, both of them may be sending the money and expect Tata Motors to pay both of them. Of course, Tata Motors is not going to pay both of them, it's going to pay only one of them. So that becomes an issue, right? How do you make sure the supplier is not trying to cheat and is not showing their invoice, a duplicate version of that invoice to two people. So these duplicate invoices are a huge challenge in today's world today. And there are also challenges about under-reporting or over-reporting. For instance, a supplier could say, hey, Tata Motors has given me these 10 invoices, the total worth is actually 1 lakh rupees, whereas it might just be 90,000, right? So there might be issues such as that are also problematic, because these are all paper documents, it can easily be tampered and so on. And they are prone to errors, right? So there's a lot of errors that happen along the way, right? The supplier will say, hey, I sent you 10 shipments, and Tata Motors will say, I received only 8, right? So those sorts of discrepancies also happen. So all this entire process is fairly manual today, and it's very expensive and very risky and error prone, and there's a lot of manual reconciliation that happens between these parties to make sure things happen smoothly. Again, here with blockchain, if you can bring these parties onto a blockchain network, then blockchain can be a single source of truth. It also eliminates these issues of any kind of fraud that might happen. It automates this process, so you don't have to wait for the other person to manually do some work and so on. So there are actions and responsibilities for every participant in this ecosystem, and that's what is captured in this slide. And the benefits, right? So every participant in this ecosystem gets some benefit out of participating in this ecosystem. That's why they're going to be they'll be willing to come onto the blockchain. And we are already working with Mahindra Finance on this in India, where pretty much this use case was what they are targeting, with some complexities, of course. So that comes to the end of what I wanted to talk about, how blockchain is being used in a very big way in trade finance and supply chain finance for various kinds of financing. So there are a couple of interesting reads as part of our fun reading section this week. So one article is on trade finance and SMEs. This is by the World Trade Organization. It's an interesting read to say how if we can just make certain changes to the way trade works today, there can be significant improvements and benefits, especially to small and medium enterprises. And that is, I think, a huge deal for India, because we have a huge number of them, and it can make a really big difference for the Indian ecosystem, for Indian economy. Then there's also a very short 2-minute video on streamlining trade finance with blockchain. So I'd encourage you to watch that as well. Thank you.